Good day, everyone. Our topic is all about financial forecasting for strategic growth, which is included in our chapter 9. So, when we say financial forecasting, it is an estimating finances. At the end of this topic, students are expected to understand the concept and the perspective of financial planning, explain the benefits that can be derived from financial planning, know the elements of a basic financial planning model, understand the determinants of a firm's growth rates, know and apply the financial planning. Long range planning is a means of systematically thinking about the future and anticipating possible problems before they occur. Planning is said to be the process that at best helps the firm avoid stumbling into the future backward. Financial planning establishes guidelines for change and growth in a firm. It focuses on the big picture, which means that it is concerned with the major element of a firm's financial and investment policies without dealing with the individual components of those policies in detail. So, what is financial planning? Financial planning formulates the way in which financial goals are to be achieved. A financial plan is thus a statement of what is to be done in the future. Many decisions have a long lead time, which means they take long time to implement. For instance, if a firm wants to build a factory in 2018, it might to have begin lining up contractors and financing in 2016 or even earlier. The appropriate goal is for the financial manager is increasing the market value of the owner's equity and not just growth by itself. If the firm is successful in doing this, then the growth will usually result. Growth may thus be a desirable consequence of good decision making, but it is not an end unto itself. However, while growth rate is used in the planning process, it is considered a convenient means of summarizing various aspects of firms' financial and investment policies. Likewise, if we think of growth as growth in the market value of the equity in the firm, then goals are growth and increasing the market value of the equity in the firm are not all that different. For planning purposes, it is often useful to think of the future as having a short run and a long run. The short run planning in practice usually covers the coming 12 months, while financial planning over the long run is takes to be the coming 2 to 5 years. This time period is referred to as the planning process that must be established. The second dimension of the planning process that needs to be determined is the level of aggregation. Aggregation involves the dimension of all of the individual projects together with the investment required that the firm will undertake and adding up this investment proposal to determine the total needed investment, which is treated as one big project. After the planning horizon and level of aggregating are established, a financial plan requires inputs in the firm in the form of alternative sets of assumptions about important variables. This type of planning is particularly important for cyclical businesses or business firms whose sales are strongly affected by the overall state of the economy or business cycles. Due to the amount spent in examining the different scenarios and variables that will eventually become the basis of a company's financial plan, it seems reasonable to task what the planning processes will accomplish. Among the more significant benefits of derived from financial planning are the following. First, it provides a rational way of planning options or alternatives. The financial plans allows the firm to develop, analyze, and compare many different business scenarios in an organized and consistent way. Various investment and financing options. Second, interaction or linkages between investment proposals are carefully examined. The financial plan enables the proponents to show explicitly the linkages between the investment proposal for the different operating activities of the firm and its available financing choices. Third, possible problems related to proposal are identified. Action to address them are studied. Financial planning should identify what may happen to the firm if different events takes place. It should address the actions the firm will take if expectations do not materialize, and more generally, if assumptions made today about the future are seriously in error. The objective of financial planning is to avoid surprises and develop contingency plans. Then, feasibility and internal consistency are ensured. Financial planning is a way of verifying that the goals and plans made for specific areas of a firm's operations are feasible and internally consistent. The financial plan makes explicit linkages between different aspects of a firm's business, such as the market share, return on equity. Lastly, managers are forced to think about goals and establish priorities rather. Through financial planning, directions that the firm would take are established, risks are calculated and educated. Alternative courses of action are considered thoroughly. So there are 6 financial planning models. Financial planning process will differ from firm to firm, just as companies differ in size and products. However, a basic financial planning model will have the following common elements: A. Economic environment assumptions. B. Sales forecasts. C. Pro forma statements. D. Asset requirements. E. Financial requirement and additional funds needed. In economic environment assumption, the plan will have to state explicitly the economic environment in which the firm expects to reside over the life of the plan. Among the more important economic assumptions that will have to be made are the inflation rates, level of interest rates, and the firm's tax rates. In sale forecasts, an externally supplied sales forecast considered the driver shall be the head of all financial plans. The user of the planning model will supply this value, and most other values will be calculated based on it. Planning will focus on projected future sales and the assets and financing needed to support those sales. A firm's ability to sustain growth depends explicitly on the following factors. Profit margin. It is an increase in profit margin that will increase the firm's ability to generate funds internally and thereby increase its sustainable growth. The financial policy is an increase in the debt-equity ratio, increase the firm's financial leverage because this makes additional debt financing available. It increases the sustainable growth rate. The third financial planning model is the pro forma statement. A financial plan will have a forecast statement of financial position, income statement, a statement of cash flows, and statement of stockholders' equity. These are called pro forma or projected statement, which will summarize the different events projected for the future. Then, the asset requirements, where the financial plan will describe projected capital spending. At a minimum, the projected statement of financial position will contain changes in total fixed asset and net working capital. These changes are effectively the firm's total capital budget. Proposed capital spending in different areas must thus be reconciled with the overall increases contained in the long-range plan. Aside from asset requirements, there is also financial requirements, where the financial plan will include a section about the necessary financing arrangements. This part of plan should discuss dividend policy and debt policy. Sometimes firm will expect to raise cash by selling new shares of stock or by borrowing. In this case, the plan will have to consider what kinds of securities have to be sold, and what methods of issuance are most appropriate. Lastly, the additional funds needed. After the firm has a sale forecast and an estimate of the required spending on assets, some amounts of new financing will often be necessary because projected total assets will exceed projected total liabilities and equity. In other words, the statement of financial position will no longer balance. For example, a firm with a greater number of investment opportunities and limited cash flow may have to raise new equity. Other firms with a few growth opportunities and ample cash flow will have a surplus and thus might pay an extra dividend. In the first case, external equity is the plug variable, and the second, the dividend is used. The remaining topics are to be discussed by Ms. Julina Mindeja and Mr. Jason Mughal. Thank you.